For more on finance, I'm joined in Sydney by Tom Boyadjian, Senior Vice President for Foreign Exchange at Global Markets. Good morning to you, Tony.
Good morning, Del.
So, as I mentioned, the GDP figures are due out today. What are the expectations? What are we looking at?
Well, it's funny you should say that, Del. The market thinks that we're going to see a pessimistic number today because some banks are forecasting that Australia's on the brink of a technical recession. We're not as pessimistic as that because we saw last quarter a 1.1% growth in GDP. Our forecast, the Compass Global Markets forecast for quarter one this year is 0.3%, which should translate to an annualised figure of 1.6%. Now, mind you, that's a lot lower than where we were this time last quarter on an annualised basis. It was at 2.4%. So we could see some negatives for the local market depending on those numbers today. And it's still uncertain as how the recent falls in commodity prices, in particular iron ore, which has fallen by 50% over the past 6 months, what sort of impact that will have on the Q1 GDP numbers today. But we're expecting a 0.3% expansion in GDP.
Yeah, Tony, that's all I wanted to ask you because, of course, last quarter beat everyone's expectations, came out very strong. But this quarter, why are the expectations so negative? I mean, what is some of the other economic data that's perhaps leading to these negative expectations today?
Well, in Australia, we've got very weak wages growth. We know retail sales have been very sluggish. There's this growing momentum of risk sentiment. We're in a low inflationary environment, and we've got very high or record household debt levels, and this is impacting on consumer sentiment. But in terms of GDP figures, one of the litmus tests or catalysts we saw yesterday was the current account balance figures that came out, and that showed that Australia's current account deficit has actually narrowed from $3.5 billion to $3.1 billion, which is a positive. It's a positive development, but the market was disappointed with the outcome because they were hoping to see a surplus. Now, we haven't seen a current account surplus in Australia since 1975. So the all-important GDP figures today will certainly be a good report card on where the economy is.
Yeah, they're due out later this morning. The ASX, of course, fell on those negative expectations. But also the Reserve Bank came out with its rate decision yesterday, largely in line with expectations, holding those rates.
Yeah, that's right, Del. Reserve Bank kept interest rates on hold. They've kept interest rates on hold now for 10 consecutive months. They also reiterated their neutral policy stance, which means they believe that the next move in interest rates, whether it's a rate hike or a rate cut, is roughly about the same. So that's seen the market tempered in terms of interest rates in Australia. And look, the Australian dollar is obviously going to be impacted by that. The Australian dollar is fundamentally influenced by what happens in the Asian Pacific region, and if the Chinese economy continues to grow between 6 and 7%, it should keep the Australian dollar well supported. Now, overnight we saw the Aussie dollar move back above 75 US cents. We believe it's on target to retest the 77-cent level we saw recently, right. But we believe it's going to be range bound between 73 and 77 for the time being.
Well, so that's interesting to see it climb. What's the US Fed likely to do? Are they likely to raise rates soon?
Well, look, to be perfectly honest, it's the US economy isn't travelling as well as the market would expect it to. They've had really weak growth numbers. Retail sales have been sluggish. Consumer sentiment there has been tarnished by the political uncertainty. You know, in my 30 years experience in financial markets, I haven't seen this much uncertainty in the US market. The Federal Reserve is reluctant to raise interest rates because the economy is slowing. But for all intents and purposes, the futures market has priced in an 87% chance that we'll see a rate rise, albeit of 0.25% next week. But we believe it could be a dovish hike, Del, which means we'll have one rate rise now, and then they'll stall and they'll be on hold for the rest of this year, which should limit the US dollar upside and hopefully give the Aussie dollar some more appreciation ability.
All right, Tony Boyadjian from Compass Markets, thanks so much for your time this morning.
Pleasure, thank you.